All right, in this video, I'm going to talk about price points and why they are important in real estate, especially as a new real estate investor. If you're just starting out, your price point is definitely going to matter because of the barrier to entry when you're a new investor. All right, so what I mean by that is if you decide that you want to invest in a market where the price points are between $30,000 and $50,000 versus an area where the price points are $300,000 to $500,000, that is going to determine how much money that you need to raise or how much money you need to have in the bank to buy the property cash, or how much of a down payment that you're going to have to put down if you're getting hard money. And that's what I mean by the barrier to entry. There are a lot more people who are able to raise $50,000 or have $50,000 in their bank account or have a down payment for $50,000 if they get hard money. I'm not even sure if you can get hard money on a $50,000 property, but you get what I'm saying. The barrier to entry is a lot easier in that aspect because it doesn't take as much money. There's more people that are able to do it. Now that being said, because the barrier to entry is lower, then that causes more competition, right? So that's one thing you have to keep in consideration when you are choosing your market and choosing which price points you want to go after. It may be easy to go in that market to where you can, only spend $30,000 to $50,000, but there's a lot of other people who have that same mindset versus, somebody who's looking to buy $300,000 to $500,000 houses. So the barrier to entry may be easier, but the risk is lower and really the reward is lower. Versus, the other way around where the $500,000 property, the risk is higher because, that investor or you being a new investor, you're risking way more money, but obviously there's a bigger reward. And because there are less people who are willing to risk way more money, then that drives down the competition. So you really want to keep that in mind when you're choosing markets. Yes, the barrier to entry for a lower price point market is it's an easier barrier to entry. However, you might want to consider going into a higher price point market because once you establish yourself in that higher price point market, you can really do some damage. You can really set yourself up for success in those higher price point markets because there's not as many people who are willing to take on that risk, or there's not as many people who have that type of capital in their bank account, or don't know how to raise that much amount of money on those higher price point properties. So when you are choosing your market and you're looking at the different price points, it is very important to know exactly what price point you want to be in. And you want to think more long term, right? So, yeah, you can start out in a lower price point market and, say you want to let me just get my feet wet. Let me start with a $30,000 house. You can do that. And there's nothing wrong with that. If that's how you want to start out, that's fine. Or you can just go ahead and just dive into the higher price point markets and start making a lot of money, from out the gate. And that way, because either way, it's going to take the same amount of effort, it is what it is. But the barrier to entry is going to be a lot easier on a lower price point property versus, a property that has a higher price point. It's going to be a little bit more difficult to get into that, to get your foot in the door in the higher price point markets, but it's very doable. That's how I started. I started investing in Miami, Florida, where the price points are a lot higher versus somewhere in like a Jacksonville, Florida, or in Midwest. And that brings me into my next reasoning of why price points are important and matter in real estate, because the margins are extremely different. All right. So when I started investing in Miami, Florida, that's where I started. I was, whether it be wholesaling or flipping houses, I started wholesaling. So let's just stick with wholesaling. So wholesaling, I was able to really get some home run deals because the margins were so because the price point's higher, the margin is going to be higher versus, in a lower price point, the margin is going to be lower. So I could easily make $50,000-$60,000 on a wholesale deal, whereas the properties that are lower price points, you are really kind of capped on how much you can make because the price points are so low, right? There's only so much you can mark up in a market that doesn't appreciate well. So while there are wholesalers who are doing $5,000 and $10,000, on a wholesale deal and a lower price point, there are wholesalers who are doing 5 times that, 10 times that in a market that has higher price points because the margin's there, right? And then you kind of want to decide, all right, do you want to be in business to do a lot of deals, all right, to have a lot of volume, or do you want to be in business to have that margin, to be in that margin business? And that's where price points come into consideration as well. That's why price points are important. It helps you identify what type of investor you want to become. So, I mean, personally, I think it's better to be that investor. You may not do as many deals, but those deals, when you do a deal, you do a deal. And you are able, that opportunity is there in those higher price point markets. In the lower price point markets, there's opportunity there, okay? If you want to wholesale or flip houses, yes, the opportunity is there. You are going to have to do more deals, okay, which can also cause, anxiety, stress, more systems in place for your business, making sure you have, the right resources to be able to do a volume type business. Yeah, you can make money that way as well. But you just have to decide how you want to do it. Do you want to be a volume type business or a margin type business? And either one works. They both work. They really do. But you just have to, that's why I was saying, looking at it long term, I would rather personally do a few deals a year and make 6 figures or more on those few deals versus having the headache of just constantly churning deals. There's a lot that goes into that. So that's something that you want to consider when you are looking at, price points. And that's the reason why price points are extremely important. Now, whatever you decide to do as an investor, whether you decide to go into the lower price point markets or go into the higher price point markets, what really matters the most is just starting, okay? So don't waste your time or don't get too hung up on where you need to invest. I personally think that you should invest in your backyard. If your backyard just happens to be a lower price point market, that's fine, all right? It is what it is. Now, if you want to go to the higher price point, great, but just start, okay? So just start, whether it be a lower price point market or a higher price point market. Luckily for me, my backyard was Miami, Florida. That was my backyard when I started. The price points there are higher than most markets. And because of that, I'm actually able to reap the benefits of having those higher margin wholesale deals, flip deals, and having rental properties that cash flow and appreciate at the same time. And that's the reason why I'm more pro higher price points, because from my personal experience, I've been able to really see what investing in a higher price point market can do for you. I also have a few properties in lower price point markets, and if I really had to choose between the two, I would always choose the higher price point markets. Do I get a better cash on cash return from the properties that are in the lower price point market? Yes, I do. However, long term, okay, it benefits me more to, invest in a property that's in a higher price point market. Short term, you're going to get a better cash on cash return. You're going to get better cash flow. All right. Because the price points are so low, that's less money you have to put in the deal, which means, a better return, a better cash on cash return for you in the short term. But long term, you really want to try to get into markets where you can cash flow, have good appreciation, and can wholesale and flip and make huge margins. So if you were to start in a lower price point market, you're happy there, great. You're making a whole bunch of money there, great. However, I will challenge you to try to get into the higher price point markets because there's more profit, there's more opportunity, and long term, it helps you out as a real estate investor. Okay, so just do what you got to do for now until you are able to raise the capital or acquire the capital to go into a higher price point market. All right, because that in the long run is going to help you versus a lower price point market. All right, and this video wasn't really supposed to be about which one is better. Okay, they both, you're investing in real estate. They both have great pros to each one of them. But like I said, the main thing for you to do is to just start. Just start. Get a good deal. Get a deal that's going to make you money. And then once you wholesale that deal, flip that deal, burr that deal, take that money and put it back into another property. Okay. And just keep doing that and keep doing that until you have enough capital to go into a market that you want to go into. I hope you got value out of this video. If you did, please like and subscribe, and I'll see you next video.